Okay, zone two.
Hello, I'm Steve Davis from San Francisco. I'd like your advice on how to understand annual reports, what you look for, what's important, what's not important, and what you've learned over the years from reading thousands of reports. Thank you.
Well, we've read a lot of reports, I will tell you that. And we start by looking at the reports of companies that we think we can understand. So we hope to be reading reports, and I do read hundreds of them every year. We hope to be reading reports of businesses that are understandable to us. And then we see from that report whether the management is telling us about the things that we would want to know about if we owned 100% of the company. And when we find a management that does tell us about those things and that is candid in the same way that a manager of a subsidiary would be candid with us and talks in language that we can understand, it definitely improves our feeling about investing in such a business, it definitely improves our feeling about investing in such a business, and the reverse turns us off to some extent. So if we read a bunch of public relations gobbledygook, it has some effect toward a business. We want to understand the business better when we get through with the annual report than when we picked it up. And that is not difficult for a management to do if they want to do it. If they don't want to do it, we think that is a factor in whether we want to be their partners over a 10-year period or so. But we've learned a lot from annual reports. For example, I would say that the Coca-Cola annual report over the last good many years has been an enormously informative document. I mean, I can't think of any way if I had had a conversation with Roberto Goizueta or now Doug Ivester, and they were telling me about the business, they would not be telling me more than I get from reading that annual report. We bought that stock based on an annual report. We did not buy it based on any conversation of any kind with the top management of Coca-Cola before we bought our interest. We simply bought it based on reading the annual report, plus our knowledge of how the business worked. Charlie?
Yeah, I do think if you've got a standardized bunch of popular jargon that looks like it came out of the same consulting firm, I do think it's a big turnoff. That's not to say that some of the consulting mantras aren't right, but I think there's a lot for sort of candid, simple, coherent prose. A lot to be said for it.
Almost every business has problems, and we just assume the manager would tell us about them. We would like that in the businesses we run. In fact, one of the things, we give very little advice to our managers, but one thing we always do say is to tell us the bad news immediately. And I don't see why that isn't good advice for the manager of a public company. Over time, I'm positive it's the best. I'm positive it's the best policy, but a lot of companies, they're dying just to pump out what they think is good news all the time, and they have this attitude that that you've got a bunch of animals out there to be fed, and that they're going to feed them what they want to eat all the time. And over time, the animals learn. So we try and stay away from businesses like that.
What you seldom see in an annual report is a sentence like this: "This is a very serious problem, and we haven't quite figured out yet how to handle it." But believe me, that is an accurate statement much of the time. All right, zone 3.
I'm Larry Dirks, and I live in the area, and I would like to know what your prediction is for Coca-Cola's long-term growth versus Pepsi-Cola's recent efforts to increase their competitiveness with Coke.
Yeah. Long term, I would expect Coke to continue to gain versus Pepsi.
What has he been doing while I was gone? What'd you say, Charlie? I knew I was taking a chance. What was the question?
I said that long term I expected Coke to continue to gain versus Pepsi.
Oh, well, it's those kind of insights is why we keep him on the job year after year. Zone 1.
I'm Ben Knoll, and I'm from Minneapolis. And first, I just wanted to thank you for providing your past annual letters to the shareholders, and Mr. Munger for providing your speech to the graduate students at the USC a couple years ago. Drawn a lot of insights from that, not only in investing, but also in my day job as a business manager. And I'm wondering if you could help me with my summer reading list and provide some additional suggestions for reading in the fields of investing and management, other than the standards of Graham, Fisher, so forth.
Charlie?
Yeah. I have recently read a new book twice, which I very seldom do. And that book is Guns, Germs, and Steel by Jared Diamond. And it's a marvelous book. And the way the guy's mind works would be useful in business. He's got a mind that is always asking why. And he's very good at coming up with answers. I would say it's the best work of its kind I have ever read.
I read a little easier book recently. I'm not even sure of the title. I don't pay much attention to the titles when I get into the books, but it's something to the effect of the quotable Einstein. I mean, it's a lot of his commentary over the years, and it's great reading. The Fermat Theorem was the book. That isn't the exact title either, but it's the story of the discovery of the answer on that. That's a very interesting book. One of our shareholders from Sweden gave me a copy of that when I was in New York, and I've enjoyed it. Zone 7.
Yes, Bill Ackman from New York. Is there a price at which it's inappropriate for a company to use its capital to buy back its stock?
Give me that again.
For example, Coca-Cola at 40 PE. Is that a smart place for Coke to deploy capital?
Well, it sounds like a very high price when you name it in terms of a PE to buy back the stock at that sort of number. But I would say this. Coca-Cola's been around 12 years now, and there are very few times in that 112 years, if any, when it would not have been smart for Coca-Cola to be repurchasing its shares. Coca-Cola is probably, in my view, among businesses that I can understand, it's the best large business in the world. I mean, it is a fantastic business. And we love it when Coke repurchases shares and our interest goes up. We owned 6.3% of Coca-Cola in 1988 when we bought in. We actually increased that a little bit a few years later. But if they had not repurchased shares, we probably would own about 6.7% or 6.8% of Coke now. As it is, we own a little over 8% through repurchases. There are going to be about 1 billion 8-ounce servings of Coke sold around the world, or Coca-Cola products sold around the world today. 8% of that is 80 million, and 6.8% is 68 million. So there are 12 million extra servings for the account of Berkshire Hathaway being sold around the world. And they're making a little over a penny a serving, so, you know, that gets me kind of excited. And I think all I can tell you is I approve of Coke repurchasing shares. I'd a lot rather have them repurchasing shares at 15 times earnings, but when I look at other ways to use capital, I still think it's a very good use of capital. And maybe the day will come when they can buy it at 20 times earnings, and if they can, I hope they go out and borrow a lot of money to buy a ton of it at those prices. And I think we will be better off 20 years from now if Coke follows a consistent repurchase approach. I do not think that is true for many companies. I mean, I think that repurchases have become in vogue and done for a lot of silly reasons. And so I don't think everybody's repurchase of shares is well reasoned at all. We see companies that issue options by the ton and then they repurchase shares much higher. I started reading about investments when I was 6, and I think the first thing that I read was, buy low, sell high. But these companies, through their options, they sell low and then they buy high, and they've got a different formula than I was taught. So there are a number that we don't approve of. But when we own stock in a wonderful business, we like the idea of repurchases, even at prices that may give you nosebleeds. It generally turns out to be a pretty good policy. Charlie?
Well, I think the answer is that in any company, the stock could get to a price so high it would be foolish for the corporation to repurchase its shares.
Sure.
And you can even get into gross abuse. Before the crash, the Insul utilities were madly buying their own shares as a way of promoting the stock higher. It was like a giant Ponzi scheme at the end. So there's all kinds of excess that's possible, but the really great companies that buy at high price earnings, that can be wise.
Our interest in Geico went from 33% to 50% without us laying out a dime, because Geico was repurchasing its shares. And we benefited substantially, but we benefited a lot more, obviously, when prices were lower. I mean, our interest in the Washington Post company has gone from 9.5% to 17.5% over the years without us buying a single share. But the Post or Coke or any number of companies don't get the bargain in repurchasing now that they used to. We still think it's probably the best use of money in many cases. The question about recommending the stock, we've very seldom had stock recommendations over the years. As I think back to 1965, I can't think of a lot of brokerage reports that have recommended Berkshire. I'm not looking for any, reports at all. We are not looking to have Berkshire sell at the highest possible price, and we're not looking to try and attract people to Berkshire who are buying stocks because somebody else recommends them to them. We prefer people who figure out for themselves why they themselves want to buy Berkshire, because they're much more likely to stick around if they enter the restaurant because they decide it's the restaurant they want to eat at than if somebody has touted them on it. And that's our approach. So we do nothing to encourage, but I think even if we did, we probably wouldn't generate a lot of recommendations. It's not a great stock to get rich on if you're a broker.
Yeah, I think the reason... I think one of the main reasons why it's so little recommended in the institutional market is that it's perceived as hard to buy in quantity.
We prefer, we've got some good institutions as holders, including one that's run by a very good friend of ours, but frankly, it's more fun for us to have a bunch of individual shareholders. I mean, you see it translates, if there's money made, it translates into changes in people's lives and not some change in somebody's performance figure for one quarter. And we think that individuals are much more likely to join us with the idea of staying with us for as long as we stay around. And that's the way we look at the business. Very few institutions look at investments that way, and frankly, we think they're often less rational holders than we get with individuals.